perfect time to get you on the UK and the situation that's unfolding there. How can the UK restore credibility at this point?
Well, it was interesting overnight. Obviously, the IMF called on the UK to reevaluate their tax cuts. So we are going to hear more from the government later this month about the idea this isn't just tax cuts to have a try and generate a boom amidst a recession, that they are going to do something to support growth. But you're right, the onus is on the Bank of England to take appropriate action. We've had the message. It's a big fiscal response. It requires a significant monetary offset. They will need to raise rates aggressively at the next couple of months, but the fact is there's a lot of monetary tightening already underway that's going to be impacting via the mortgage market as well. And also it's important for the Bank of England what it means for the next couple of years. It's their medium-term outlook. You've got to remember the Bank of England back in August was saying that on market rates, inflation within 3 years would be back down at about 1%. Actually, are they going to think about reassessing their medium-term outlook as a consequence of this policy stimulus? But you're right, for now, the markets, they just want to see hefty rate rises, and they'll probably get one in November.
Yeah, well, Janet, take us then all the way through March then. How much do you think the Bank of England will need to move now? And incrementally, you alluded to that. They were already moving anyway, quite substantially. So give that total number to us.
Well, the Bank of England, it may have started before the Fed and the ECB, but generally speaking, it has moved in smaller increments. Even as the ECB moved to 75 basis points, whenever it's been a kind of finely tuned decision, they've always erred on the more dovish side. So even at the last meeting, it was a three-way split, and they only went for 50, and most people think they should have gone for 75. We've got base rate or bank rate rising to 4.25% by the first quarter of next year. The risks are to the upside, but in terms of what the market's pricing in at 6%, obviously the bank's not going to say that at this point. So we're not going to 6%. Yeah. They have to give the market what it wants. But actually, even 4.25% on bank rate for an economy that's really tied into short-term interest rates as well as fixed rates priced off swap rates, even getting over 4% on bank rate is going to have a significant tightening effect on the economy.
And we seem like there's just plenty of bad news all around. I'm just wondering, do you think the UK and maybe if you broaden it out to G4, can we still see that soft landing scenario, or are the recession odds just continuing to rise from here?
For Europe, it's either already in recession or about to go into one. The UK already had a negative Q2, partly because of the bank holiday effect, a negative Q3, and even with this sizable fiscal stimulus, there is going to be an ongoing recession over the next couple of quarters, and the Bank of England knows that. Remember, the Bank of England is one of those central banks that comes up with forecasts that are priced off market pricing for interest rates. They're going to be forecasting a deepening recession. The euro area is on the verge of a recession, and clearly the news overnight regarding the gas situation is another headwind that they really didn't need. Gas levels in Europe, we had seen some refilling of the gas. The hope was that we could get through the winter without any enforced rationing, but if there is going to be ongoing curtailments of gas supplies and Europe hasn't arranged longer-term contracts, then that does pose the risk again of enforced rationing, which would deepen the recession in the euro area.
So, Janet, best case then for Europe as it pertains to that?
Sorry, I didn't quite hear the question, but in terms of Europe, I think that the difficulty is, I mean, it was interesting hearing your introduction about China and deflation risks, because clearly China has been slowing down. I think in terms of the European context, particularly within the Eurozone, in many ways the recession is being caused by inflation itself. It is a supply shock for the Eurozone, and that is what is causing the deepening recession. So even though the ECB knows that the economy is going to be weakening, it may not be in their central forecast at this point in time, it's not the kind of downturn that is going to lower inflation swiftly. Inflation is going to be moving higher in the euro area over the next couple of months. We are clearly in the midst of significant pay negotiations, and for the ECB, they can't give any hint whatsoever that they're going to be taking a pause anytime soon. They need to keep inflation expectations anchored and keep tightening tightening at least until early next year. So as we see it, it won't just be the Bank of England or the Fed, but the ECB will still be tightening at least into the first quarter. Then maybe it takes a pause because the economy is actually in recession for an extended period, but it's not the kind of recession that's going to eliminate the supply side challenges or indeed bring in inflation down swiftly. So it could even find itself resuming rate rises by the end of 2023.
Yeah, Jen, I was about to ask you to just help us, dig through that part of it. Assuming we take out the supply shocks, and a big part of that is obviously the gas and the energy story, and Europe isn't in a recession, what is driving inflation? Why is inflation so high as we speak still?
Well, even within Europe, you've got some divergences on the inflation rates. And clearly, there are divergences on inflation globally. In the US in particular, a lot of the yes, everyone's had the higher food and higher energy prices, but a lot of the inflation across the US has been driven by strong consumer demand, has pushed up consumer prices. Much more of the inflation across Europe has been driven by energy. It's contributing nearly half of the inflation. And you've got, depending on the energy mix, and the reliance on Russia, and the ability, therefore, of government to subsidise prices, you're seeing some divergence on inflation rates. So certainly on our forecasts, we see German inflation rising well into double digits, over 12% in the coming months, whereas in France, where clearly they capped electricity prices at an earlier stage, we don't see inflation going beyond about 7%. So there is a lot of divergence, but relative to other parts of the world, the energy story in Europe, even as oil prices have come down and you've seen some easing in gasoline prices in the US, it is those 60, 70, 80% increases in utility prices for consumers and many multiples of that for the corporate sector that is really weighing on the outlook for growth.
Where do you see the recovery in China next year? And might that be limited by the slowdown elsewhere, or might that actually put a floor underneath global growth?
Well, China clearly has seen a very marked downturn in the second and the third quarter, although at least it lessened a little bit, it would appear in the third quarter. But one area of persistent strength over the last year has obviously been the export front. It's outperformed other regions, it's gained market share in certain economies, and now with Europe heading into recession, it's quite clear that even China's export growth is going to potentially be slowing. So really increasingly it hinges on the domestic economy. And I don't think anyone expects that the property sector is going to be the driver of growth that it has been for much of the last decade or two. But if the property sector can reach a stage where it's less of a drag on the economy, that could certainly be helpful. And obviously, huge amount hinges on COVID. And it's quite clear it's not going to be the V-shaped recovery that we saw in 2020, that the pace of reopening is going to be much more glacial throughout 2023, that we're not going to get an immediate reopening after the Party Congress. And as I think you were discussing earlier, most likely it's going to be from about March onwards, we see a gradual reopening of the economy. So, yes, we still need a response on the property market to get an improvement, and we need the ongoing improvement in infrastructure and continued strength in manufacturing investment to drive the recovery.
You could argue part of why we're seeing the weakness in the currency, but a lot of it has to do with the dollar strength that we're seeing, this relentless rally in the greenback, Janet. What does this mean for corporates? What does this mean for the global economy?
Well, you're right. Globally, the strong dollar is a major event. It's interesting. Everyone's been focusing on the UK and where sterling is, but even the UK on a trade-rated basis and in real terms is actually only back where it was, when Brexit first, the vote was still held. So we need to look at all these currencies on a trade-weighted basis. But I still think that China and to some extent Japan are in a different camp, because they are both economies that have got very low inflation and in many ways still risks of deflation. They are purposefully, through inflation, pursuing more divergent policies. I think it's those countries that are trying to stop their currencies depreciating instead of actually just raising rates, because they've actually still got something of an inflation problem. So the dollar is tightening global financial conditions, but in some countries they should be doing more domestically to raise interest interest rates. But for China, it's, you know, it still has a basket to some extent, and moves in the trade weighted are important. But as we well know, for exports, it's demand that's more important than any exchange rate, particularly in a downturn.
Janet, I know you have to go, so final question for you. You look at nominal exchange rates. You could say we're in a crisis, currency crisis. Do you think we're anywhere near an actual currency crisis?
Well, it's very rare that you get an actual currency crisis in isolation. You get fiscal crises, you get balance of payments crises. You know, even when people think back to the Eurozone crisis in the wake of the global financial crisis and everything that happened in the periphery, it was often referred to as a Euro crisis. It was actually a balance of payments crisis. It was when you had countries with large current account deficits in the periphery were the ones that faced the challenge. And I think as much as people are saying this is a sterling crisis, is this really a sterling crisis in the UK? It actually is concerns about the fiscal sustainability and a balance of payments sustainability, double deficits that in many ways are larger than it was even in the course of the 1970s. So it manifests itself in the exchange rate, but it's not a currency crisis. You know, the foundations are the problem, and that's what needs to be addressed.